Meanwhile, the government has proposed major changes to the national tax code, shifting gears from a policy centered on supporting corporate growth to one aimed more at improving the lot of the average household. But one question is, will the new measures result in enough tax revenue to support more government spending? Our Oh Soo-young reports.
Job creation, fair income distribution and bankrolling government expenditures. These are the three pillars of the Korean government's tax revision plan, supporting its 5-year policy map of income-driven growth.
To achieve an economic paradigm shift away from low growth and polarisation, we must adjust and expand tax revenue to support income-driven growth and welfare services.
This means new tax breaks worth nearly $1.2 billion in housing, childcare and other living expenses for low and middle-income households, as well as small and medium businesses that employ more permanent workers, improve labour conditions and boost wages. Meanwhile, the government's wealthiest firms and individuals will have to reach deeper into their pockets. The corporate tax rate will be raised from the current 22% to 25% for companies with annual revenues exceeding $178 million. The income tax rate for Korea's wealthiest individuals will also be hiked to 40% and 42% respectively. The revision also proposes cuts in various deduction schemes, including those on capital gains for major shareholders, transfer of assets, as well as R&D investment. These adjustments are expected to boost tax revenue by nearly $5 billion a year. But the big question is whether these measures will be enough to finance the government's 5-year policy initiatives, which come with a price tag of $159 billion. The government expects to generate $54 billion from natural tax gains over the next 5 years, with the economy currently growing at a better than expected pace.
An extra $9.9 billion in taxes were collected by May this year, but whether extra revenue will continue to increase depends on the health of the economy rather than simple government promises.
Experts say another tax hike seems inevitable, as the burden of tax is directly linked to the scale of welfare services.
Reducing tax benefits for large companies would raise the actual corporate tax collection rate, which is estimated to be lower than the nominal tax rate. Also, a hike in value-added tax, which is relatively low in Korea, could substantially boost revenue to support welfare. This would generate a redistribution effect in line with the government's agenda.
Lawmakers are set to deliberate over the tax revision plan in September, during the National Assembly's next plenary session. Oh Soo-young, Arirang News.